Okay, good afternoon. Welcome to the Bob Unger Show. And we have a real honor and privilege of having a guest who's courageous enough to not wear a mask on Zoom. That's how paranoid people are today. They'll even wear a mask on Zoom. And David Morgan is the publisher, I believe, of the Morgan Report, correct?
Correct.
Which is a newsletter that educates people on the subject of gold and silver and precious metals as it relates to the economy. He also makes recommendations about specific investments in his newsletter, and it's been around a long time. And I'm going to ask David to give us a little of his background so we just know, how did he figure this field out? Since none of us are taught this in school, none of us are taught this in the newspapers or on the boob tube. How did you come to realize that something was rotten in Denmark?
Yeah, great question. Before I start there, Bob, just want to add a little bit onto the Morgan Report. We do gold and silver, obviously, but we also look at all the resources. We're the first in the rare earth elements. We have uranium on the list right now. We've also broken into, believe it or not, the cryptos. I'm not a fan of Bitcoin. Let me get that out there. So you think you're going to get a lot of information on Bitcoin. I write about it, but I'm not a fan of it, but I am a fan of the blockchain. So the Morgan Report looks at all investments in the resource sector, but right now we're primarily focused on gold, silver. We have uranium, as I said. So moving on, how did I get interested in this? And that's a fascinating question. And the story goes like this. I was paid 25 cents a week to, keep my room clean and water my dad's orchard, which was 1 acre of land, which when you're, 10 years old looks like it's, half the planet. I mean, at least speaking for myself, your perception when you're younger of how big the world is or how big a community is or all that, it's a little, you don't have any real reference point. So anyway, it would take probably an hour or two to water the orchard, get those 25-cent pieces. I stacked them up. We were out in the country. Then one day I got what I call a Johnson slug. And I looked at it and I held it and I looked at it and I held it. And I thought, this cannot be worth what these silver quarters are worth. It's impossible. But no one was paying any attention on the adult scene that I could tell, but I sure as heck noticed it. So fast forward to my almost obsession at the time about money. I was a pretty avid reader, had the World Book Encyclopedia, and I found out that there are people that make a living investing. I'm like, how can you become an investor? Well, you have to have money to start with. So I kind of carried that wish. And when my dad asked what I wanted to be something in finance. He blew up. He had a real bad stockbroker. He was very angry about, investments in general, and said, "No, you're not doing that. Figure something else out." So I read the career guide to the from the World Book Encyclopedia, zeroed in on aviation, and I started my career in aviation at 16 years of age. By the time I was 19, it was working toward my aeronautical engineering degree and had every rating you could get, even multi-engine and CFI. Didn't have a double ICE certified instrument instructor, but everything but. So I was teaching flying, going to college, and built up a lot of hours, got out of school, and started an aircraft career. But my passion was always in finance. So after I worked in the aircraft field for a while, went back to school, got a master's in finance / economics. And I actually left the aircraft industry and started working first for a certified financial planner, and that didn't work out too well because I saw how the game is sort of rigged. You're totally objective because you're told on the phone what stock to push. So I thought, it's the truth. You know me, I'm pretty honest, Bob. You've listened to me. And then I did work in the coin industry for a while. I didn't like that either. There's good and bad. I happen to be with one that wasn't particularly bad, but a little pushy on the higher priced items. So basically, I always wanted to write a newsletter. Once I started really getting into the field and learning from these, what I considered very deep thinkers and very knowledgeable people that talked outside of the mainstream about how to think about the economy. And how a fiat system destroys itself and why gold's important for an anchor, a monetary anchor of the universe, as Jim Dines used to call it. So that was my passion after I struggled a little bit, you might say, with my leaving the aircraft industry. I found my niche and I just made it happen. And it was slow. And I don't mind telling anybody. I mean, the first year in the business, I made $6,000, but I had enough savings and my wife was working part-time and I had low expenses that I was able to just, persevere. And by the second year, things were good. And by the third and fourth year, they were really good. And it got really, really good up until the 2011 top, which I called very accurately for my paid members. And then it slid off down and down and down and down. And we caught a bottom finally. And we're back on the upswing. So probably more of a introduction than you wanted, Bob, but that's the long version of who I am, and what I did to get where I'm at.
What year was that you started in that business?
Well, I started in the newsletter business around 98, but I started in the financial planning / coin, kind of bouncing around, trading for a living. Oh, 5-6 years prior. So I kind of waffled around trying to find a place to go. Thinking about taking the Section 7 license to be a stockbroker, which was like the absolute one thing my dad didn't ever want me to be. But no, I just, floated along, you might say, traded for a living, did okay, did some consulting, but really wasn't making a solid living until I started the newsletter business.
Yeah, it's interesting. When I first started to think about gold and silver, it was roughly around 1999. And I knew absolutely nothing, zero, less than nothing. And unfortunately, I was taken advantage of by a well-known gold company. They advertise all over the place. And I wanted to buy gold. That much I knew. I knew nothing.
Right.
But I thought in my head, country going in wrong direction, gold will go in right direction. That's the only metrics I had. I had no sophistication. I didn't know what a 200-day moving average was, nothing. And they pushed me into numismatics,
Yeah.
collectibles, which of course have massive premiums. And I never wanted to do that. I just wanted to get the bullion coins, but I didn't even know. That's how ignorant I was.
Yeah.
That the collectibles are not the same as regular bullion coins. And they've gone up, there's no question about it, but certainly not to the degree a regular bullion coin would have gone up because you don't have those kind of premiums. And I just thought that was so dishonest.
Yeah.
And here I am, I'm a lawyer, but I never sued them, although I could have.
Sure.
Because that is misleading the customer.
Yeah.
And one of the things I love about you is that you try to educate your people. You don't just want to sell something, you want to educate them. And I think our friend David Sheckman, who owns a company that sells metal, he puts out newsletters and he's constantly writing on the subject. And I love the fact that he, like you, wants to provide more than just getting a check from a customer, but really give people a general education, which filters into other subjects as well, because economics is related to everything. So I compliment you on that sincerely. And let's get into gold and silver. I know that silver is your favorite, but right now we're talking general. Why is it that gold and silver are persona non grata in the universities, on the boob tube, in the media, in everything, in the establishment conduits of knowledge? And what is your perspective on why that is?
Yeah, let's get into why gold and silver are persona non grata. Before we get there, Bob, I'd like to just back up slightly because,
Sure.
I've been advocated and mentioned many times about having 40 years, gold and silver experience. And that's true, but I just told you, only 20 something, 23 years in the newsletter business. Just for the record, the whole time I was in the aircraft industry, I was reading newsletters and was trading silver almost daily, trading gold, trading mining stocks. So, as far as, even though it wasn't my vocation, it was my avocation, my passion. So I count that because, if you put hours of study in those 20 something years or whatever, that I wasn't officially a newsletter writer, has nothing to do with the amount of time, effort, energy, and experience that I gained in the precious metals. So I just wanted to back up because I haven't really given that in-depth an intro, I think, in a long time. And I don't want anyone, oh my God, you've been saying 40 years and it's only 20. No, it's 40. In fact, I got scolded one time for the amount of calls I was making to check gold prices from the office. So anyway, back on point, when I got to my finance degree, the finance teacher, she was very smart, very precise, and she called me a silver expert, and no one had ever called me a silver expert. So that kind of gives you the background just for the audience of, well, wait a minute, David, yeah, no, I earned it. I studied, I read, whatever. So don't want to belabor it too much. So why are they persona non grata? Because they're a direct competitor to the establishment. The establishment wants to be able to control people through the monetary system. And they know the history of money, probably not as well as I do, and excuse the ego, but most of the tippity top know exactly how the system works, and it's designed this way. I mean, I just did an update. I do a weekly perspective, Bob, you may be familiar with, you might have watched a few. And last week I did one that I kind of repeated at the end, that if the Heavenly Father, God, gave Jesus 1 cent at 5% interest when he was born today in 2021, that would be the equivalent of something like 6 planet Earths. And that's just 1 penny being compounded. So it proves beyond a shadow of a doubt that compound interest is a myth. The myth being that it can continue indefinitely. This may be the reason there was a debt jubilee every 50 years. But the powers that be really aren't interested in the principle. I know that sounds ridiculous, but if you really study it, you look at the bankers, you look at the Anglo-American Empire, you look at all the stuff I've read, studied, and heard, you'll realize that the bankers know that the principal can never be paid off once you get to a certain level. But the debt interest is the way they control everything, and they don't want to let that go. Gold and silver are basically God's money. They're free and independent of the banking system. The bankers might warehouse it, and they might do this and the other, and we can get into the suppression. I know we will later. But the idea being is that it's a free market money that people can understand. It can be trusted. There's really no counterparty risk. If you own it, it's got value in and of itself. And this
Define counterparty risk for the audience.
Yeah, thank you. Counterparty risk is when you have a bank account or any investment, but we'll just use something very simple like having a bank account. You are actually a creditor to the bank. That money that you put in your bank that you call your money or your deposit or your savings is actually the bank's. Read the certificate. When you put down that signature, they tell you it's a signature card. You're signing a contract telling them that they own that, you don't, in the event, in certain circumstances. I'm not saying to run out and start a bank run, although I wouldn't be opposed to it. But the idea being that, in legal language, you got to be kind of careful. So counterparty risk means that you depend on someone else to get your asset. So you depend on the banker to be able to put those pieces of paper across the teller's window, or you depend on a stockbroker to sell the stock for you and send you the check for selling the stock, or an option or a future. So almost everything in the financial industry has counterparty risk. You're depending on a bank, you're depending on a broker, you're depending on the mutual fund head desk to send you a check. You're depending on your real estate agent to go through escrow and send you. So there's somebody that's going to write that final check to you. Whereas when you own gold, that is payment. So when you have that in your hand, you can take that gold and you can make a direct purchase or whatever, between two consenting parties. So the difference between the precious metals and almost any other financial asset I can think of is it's the means of final payment with no liability. And just to go one step further and beat the horse to death, you could obviously take a bunch of plywood that maybe a carpenter wanted and make a transaction in a barter system with it. But for monetary reasons, gold and silver are it.
Okay, very good. Now, some of the people that I know who are more educated than average, which means they're above Dick and Jane, they will come to me and say, Bob, with all the money and debt that it's really debt that the government is printing for these bailouts and the infrastructure bill and the CARES Act and this act and this act, why is it that all of a sudden, at a time when the money is just catapulting in terms of all these bailouts and the shutdown bailouts, et cetera, why is it that gold has been stymied as well, of course, as silver?
Well, again, it's the idea that gold is it's the barometer, or it's the canary in the coal mine. It's the one signaling thing that even people that have no conception of why gold is money or that it is even money. If gold really took off in a big way in the financial press, the mainstream financial press couldn't ignore it. It would really start to wake up a lot of people. A lot of light bulbs would pop over people's heads and they go, what's going on with gold? They might not know it, but they see gold's up making another new high today. And then, the cab driver starts talking about, did you know gold just made a new high again? And, so this is exactly what they don't want. They don't want the population enlightened about the monetary system and how it really works. They want them to be dumbed down. And so there's an effort to suppress the price and make sure that that the news is more or less controlled around it. When gold goes up, they'll report it, but they'll do it with, let's say, a light edge to it, meaning they just mention, gold been a new high. It's first time. And then I'll try to use add-on. It's the first time gold's been this high in 14 years, so they'll try to make it sound like it's barely, that's something you wouldn't want to wait 14 years for when the stock market makes a new high every other week, right? So, and then when it goes down, they usually have a pretty good extra commentary, Bob, which I know you know all this, but for the audience, it's like, gold is off today. In fact, it hit a 3-week low, and we've seen gold getting sold off. The banks are dishoarding gold, and the Bank of England said that they're going to sell the rest of their gold while they can still get something for it. And, so it's pretty biased, but deliberately so. Now, I've exaggerated very slightly on what goes on, but it's a mindset. It's a control the thinking around it. Paper good, gold bad. Gold's nutcases. Gold's conspiracy theory. Gold is barbarous. Gold is a pet rock. Gold is so continually these subtle and sometimes not so subtle remarks surrounding gold. And you get someone that's very educated about the monetary system, such as yourself or myself, talking about gold, and they've already got the subconscious block going against the topic. But remember, if I could counteract that some, gold is God with an L in it. So remember, gold from a monetary aspect has been good for thousands of years. And the bankers' fiat phony Ponzi schemes usually only last a few hundred years before they blow up at best. A lot of them last a much shorter duration than that.
You probably remember that Abraham, in the city of Hebron, which I was several times in, when he buried his wife Sarah, he didn't pay cash for that grave. He paid it in silver. And in fact, there's a Hebrew book called the Chumash, which is basically commentary on the Torah reading each Saturday, each Sabbath. And in the commentary, it says that a silver shekel must be a certain weight of silver according to Jewish law. And that the reason why Abraham paid in silver is because he wanted everyone to know that he was owning it.
Mhm.
Very few people know that.
Yeah, well, that's another point we didn't make, or I should make, and you can elaborate, is that gold and silver are the only way to actually have final payment. I mean, even though you think that when you sell your used car and you get, a bunch of pieces of paper, that's final payment. And for all practical purposes, it's somewhat true. But the true truth is that's a debt obligation for somebody else. Every dollar is loaned into existence. So really it isn't final payment in a legal sense. And I'm not trying to get into the minutia, Bob, you might be able to explain a little better than that. But the idea that when you pay in silver, you own it, it's done. Same thing with gold. And that's still true today. Whereas in today's world, that dollar that you're holding in your wallet actually has an obligation against it, meaning it's been loaned to existence and it's making babies, meaning that interest has to be paid on that dollar that doesn't yet exist, which means we continually have to grow the money supply. There's no way around it. Even if we had a balanced budget and we met all our obligations, we would still have to increase the money supply to be able to pay the interest that's due to the bankers for creating something out of nothing.
Well, first year in law school, we learned that a note is not money, it is a debt. And of course, what does it say on the top of all the paper currency that people call money? It says Federal Reserve note. It doesn't say Federal Reserve money. As you point out, there's a clear reason for it. So let's get into the weeds, so to speak, and let's talk about how does the government vis-a-vis their agents in the Wall Street community suppress the price of gold and silver in the various futures markets and other markets?
Well, the way it's suppressed is they started the futures industry for gold and silver. The futures industry existed for legitimate reasons, but it's been abused for a very, very long time through all the commodities, not just the precious metals, but the ags and the softs and even the financials. So the reason that it works is because the majority of money, or I'll call currency, goes into the futures exchange to determine the price. But what it's determining a price of is the derivative of gold or the derivative of silver. In other words, it's not a direct relationship between the amount of gold or silver that exists. It's a direct relationship with the amount of contracts that can be created, which is basically infinite. So if you ever think about what is the value of something that has an infinite amount, it's zero. I mean, if there was an infinite amount of paper clips and, you just could go out and pick one up, you'd never be able to sell one at the store. There's so many just laying around. Now, that's a slight exaggeration, but it basically gives the correct impression of what we're talking about. So supply and demand do play an effect. It's like, what is the supply of gold and what's the supply of silver? Well, if we're talking in the physical realm, they're precious. It's a precious small amount. All the gold that's ever mined in the world fills up something like 3 Olympic-sized swimming pools. That's pretty precious. Go to the moon and do a thought experiment, Bob. We'll do one together. So we're on the moon. We've got a big telescope. We're looking at planet Earth. Now we got to find 3 swimming pools full of gold on the whole planet. And that's everything for 5,000 years. That's a precious deal. But now let's look over and focus in on Chicago and take a look at the CME and see how much paper gold there is. Oh, wait a minute. It goes from here to the moon and back in paper terms. So I hope I'm making the point clear that when there is a lot of supply, which there's a lot of supply of paper gold or paper silver, that's what controls the price, because that's what you're buying. You're not buying gold, you're buying a derivative of gold or a derivative of silver. And the supply can be created out of thin air, just like the US dollar can be created out of thin air. Now, I've exaggerated a little bit, so to be a little bit more specific, the creation of a synthetic or a piece of paper that's good for a derivative of gold has to be backed by the entity that wants to create it by having some currency in their commodities account. However, who is the commercial interest on gold and silver? Well, they consider them financial instruments. They're the banks. And we all know that the banks, for most banks, could create money to the moon if they wish. So that's why I say what I say. In a normal market, if there ever is anything close to normal market anymore, if you go into the wheat market, the commercial interest in wheat is the people that grow wheat. In the hog market, the people that are commercial interests are the people that raise hogs. If you go into the cotton market, the commercial interests are the people that grow cotton. But when you go into the precious metals, it's the paper pushers, it's the bankers.
I see. And why is it then that only certain times the price goes down, which was last not the last 2 days, but prior to that, it was going down quite heavily, and then in the last few days, it's coming back up again. What is the difference in those days? As simple as you can.
Yeah, so I think I can do a good job at that. So the banks, as I said a moment ago, have basically infinite money. But the main traders against the banks that usually go long are what's called trading funds. People know hedge funds. A lot of hedge funds do use the futures market, there's no doubt. But there's also these trading funds, which are like pool accounts where you want to manage futures account. You believe in, the commodity sector, but you don't really have time to trade. So you write a check to XYZ Trading and you give them 10 grand to speculate in the futures market for you. That's a trading fund. And then there's the general public that you open up, you sign the documents, you say, yes, you understand what the contract says. Most people don't even read it, but they sign it away anyhow, and they throw up their money for margin and they have a brokerage account. So the people that go long, which are the general public at a small level, and the trading funds and hedge funds, have a limited amount of money. So that's where you watch the open interest, or what we commonly refer to as the commitment of traders. So you watch that closely and you see that basically we've hit the limit. The trading funds may be up. They may have bought silver at 24. They may have bought it at 20, 22, 24, 26, and now it's at 28, but they don't have any more money in their pool account. And the public basically isn't buying much because they're really the small part of the equation. And so now there's only one thing that the trading funds can do to capitalize on their paper profits and book it, to take those profits, and that's to sell. Well, we already know that the banks basically know what all the trades look like. They also know the open interest. In other words, they know when the other side's basically out of money and is ready to take profits. So when they start to take profits, the banks sell on top of them. So since every contract has to have a match, a buy, for every buy, there has to be a sell, and for every sell, there has to be a buy. So now the funds that have been long the whole time have only one way out, because they have no more money to force the price higher. They're out. So now they're forced to take profits and start selling to lock in their profits. Well, the banks sell on top of them, which puts in a lot of selling pressure, but the orders have to match. So what happens? Well, in a very heavy evenings, usually happens in the aftermarket overseas, is there's a gap. So let's just use the $28 silver high. So someone in the public, let's say, wants to buy 10 contracts at they look at their chart, they deal out their Ouija board, they do a certain dance, and they determine that 22 is the price, man. If I could only have bought it there, it's at 28. Oh, I'd be so happy. Well, they get their wish, because when everyone starts selling at 28 and there's no orders to match, the exchange will match the next order, which is 10 contracts at 27.22. And there's a gap between 28 and 27.22. That's how gaps form in the charts. And now whoever's got an order will have to get filled. Well, the funds put in stops as they go all the way up so that they limit their losses. And the stop is a sell order. So they're going to start selling for profit. That selling begets selling from the banks. And now the stops start to get hit. So the trading funds had stops in at, we'll just make it real simple, 27, 26, 25, 24, and 23, and that's it. So now almost all those stops were to lock in profits. So those stops fill the orders. The next set of stops fill the orders. The next set of stops fill the orders. The next set of stops fill the orders, and the banks are done. They've offloaded their short position. They've made money from the 28 level all the way down to, let's say it stops at 24. Their books are clean. They're squared up. They've taken advantage of the public and the funds one more time, and the game starts all over again. Give me some feedback, Bob. Did that explain it very well?
Yeah, I think so. I think it's hard sometimes when people, like when you use the term gap, we know that that means a space between a price level, and markets tend to go back to fill those gaps. But you know, this is the kind of thing. I mean, I've been studying it for a long time, and I'm learning every minute as I'm listening to you. I'm learning, which is why guys like you are so important. Because in the Morgan Report, if you constantly read it, after a while, there's a cumulative effect. And the more you read of this stuff, and you're never going to get it in any mainstream source.
Right.
You're not going to find it on Market Watch or the Communist News Network, CNN. You know, it's impossible. And so you really have to go out of your way, put it that way. And, you know, one of the problems we have in America in general, and before the show, we chatted about the relationship between morality and character and the economics of a nation, of a world. The thing about it is, a person who has character wants to know the truth. And he wants to know the truth because he cares. Most people today that I find, and I'm an observer who talks to a lot of people, and I start trouble everywhere I go. I started in supermarkets, in banks, in the public square, you name it, I'll start trouble there. Most people couldn't care less. And the thing that you'll hear the most from them is, oh, that's my kid's problem. That's very common. Or they'll say, doesn't affect me. Maybe talk about a little bit whether or not it affects them and whether or not it's their kid's problem.
Yes, well, it affects them, and this gets a little bit philosophical, which I love to touch on that topic. But the way that I see it is that you have to live a morally correct life, and none of us can as humans, but that's what we strive to do. So it isn't the kids' problems, it's the inability of, let's say, my generation to live within their means. And that is actually morally invalid or incorrect, because really the way that we're taught, or should be taught, I'm using the word should, which we're not supposed to use, but the idea is that we have to be good stewards of what we're given. And we have to be grateful for what we have. And it doesn't mean we shouldn't accumulate or have savings or plan for the future or retirement. What it does mean is that we shouldn't go overboard. And when we do borrow or use credit, we should use it consciously in a heartfelt way that it's going to be beneficial and produce more, and you're able to pay it back with the interest and move forward, because the utilization of that money today has brought more value in the future. Now, if we take that from a macro picture, this is what the US government does, is borrows money, we call it currency, from the money center bank, the Federal Reserve, which is a private corporation, on your behalf as a US taxpayer, with the idea of paying it back, which is ridiculous at this point. It's beyond comprehension. It could ever be paid back. It cannot. So it's morally invalid to put it on their kids' backs. And it's rather appalling to me to even think that someone would have the ability to say that with any kind of conscience whatsoever. To me, they don't have a conscience. So it's a moral dilemma. And I think that the more awakened young people, we'll call them the millennials, I have 2 millennial daughters, are aware, at some at a very deep level, most at a cursory to a mediocre level, that something is drastically wrong throughout the system, but particularly in the monetary system, because money controls almost everything. And the ship has to be righted. And they feel or sense that this situation is going to end. It's going to end rather badly, and it's going to end rather soon. And those that are awake are moving into alternatives like the cryptocurrency market and the precious metals markets. And this is basically the only places I see that will weather the storm the best. Now, you could argue real estate is a real asset, and it is. And there'll probably be some places where real estate is really a great way to go. Could be because it's rural property, well protected, coveted because it's a safe place to be as things deteriorate further and all that. So I wouldn't rule it out, but it's a little like buying a rare coin. You damn well better know what you're doing before you purchase it, because you might be paying too much.
Right. That's true. I have this question quite a bit, and without giving any specific recommendations, but in general terms, I've had people come over to me and say, Bob, I have $2 million, which today, it's so funny. When I was a kid, if you had $100,000,
Oh, yeah.
I thought you were the richest guy in the world, and you probably were.
Yeah.
But today, $2 million, that's nothing, especially when you live in the Northeast, in the suburbs where I live, right outside Manhattan. The taxes alone on the average house are $40,000 to $50,000 a year. And some are 100, 150 and more. And people will say to me, Bob, I have $2 million. How should I invest it? So what would you tell the average person in terms of having a balanced, reasonable portfolio that could get them through retirement in the best way you know how, without giving away specifics?
Yeah, well, I usually, in the public domain, say 10%. When I wrote the 10 rules of silver investing, rule number 10 is too much of a good thing is too much of a good thing, to make a strong case for silver. But and I did up that at a conference in San Francisco before the first Iraq war, and said I'd upped it to 20% because of what I saw, the war drums beating away. But I'll round back down to 10, but I can elaborate on that. And I think it's important because it's more important than me saying it. There was a study done by BMG Group, Nick Bearchef out of Toronto, Canada, that paid for this study independently by Ibbotson and Associates. It's IBBOTTSON, Ibbotson. And they did a study on gold as a meaningful part of a portfolio. And the question was, one, do you even need gold? And two, if you do, how much? And the answer was about 15%. And yes, all portfolios need gold. And then recently, CPM Group, which is a commodities situation in New York, they do studies on all the metals, pretty well respected, pretty well known. And Jeffrey Christian, who's the general manager for that group, CPM, did a study from 1968. So it's not going back as far as Ibbotson did, but the study of CPM from 1968 to present day, the correct amount of gold to have in your portfolio was 25%. So I know a lot of people that listen to me and other talking heads in the precious metals community are not very fond of Jeffrey Christian, but regardless of what you think of him personally, I think his work is pretty darn good. And I think most people would be shocked to know that he did that study and he didn't mess the numbers or whatever. The numbers came out 25%. And then lastly, there was a Harvard study done that proved that gold needed to be part of a portfolio. Bob, I can't quote you the amount because I don't recall what it was.
What about land and other commodities, oil, energy, regular stocks, blue chip stocks? How would you jigger that?
Yeah, that's a great question. I don't, I'm a specialist, so I don't really look too much, although I'm a very much of a market student. Nick Beresheff has gone over that before, and I forget the numbers, again, from the Ibbotson study. But stocks and bonds are heavily correlated, where they used to not be. So, when you did retirement, you had this little rule of thumb that if you retired at 60, you had 60% bonds, 40% equities. If you retired at 70, you had 70% bonds, 30% equity. So as you increased in your age, you got safer and safer by going to the bond market. That no longer applies. So Nick looks at all the assets and he looks at real estate. He looks at collectibles like, the rare coins and artwork. He looks at everything. And most of the stuff is correlated with the precious metals being non-correlated. But real estate can be non-correlated in the stock market. So I don't know the numbers, but just, okay, what do I think without giving specifics? I think having real estate in the right areas, location is good or key. For me personally, especially now, I'm speaking now, having that second rental home and the vacation home is fine if you can afford it, but look at that as a luxury and not as an investment. If you're going to have investment, I would invest in land or farmland or a rural situation that's really, really wanted by masses of people. I wouldn't look at getting that spiffy super duper condo. I have one, by the way, in Mexico, paid for it years ago, but you're not looking for a luxury item. You're looking for practicality. So land in the right areas, farmland or something like that, I think would be good. And then I'm not against stocks or bonds. I'm pretty anti-bonds at this point. There's always exceptions. There's some corporates that are probably worth it. I don't trust any sovereign bonds at this point, Bob. I don't trust the US government bonds. I don't trust the European bonds. I don't trust the Japanese bonds. I don't trust the Russian bonds. I don't trust anybody. It's a note. It's an IOU and they can't pay it. So why would you put any of your money into it? So the bond market, that's my take. Real estate, it's okay if you're careful. Stocks, if you're very selective. And commodities, generally speaking, yes, because of stuff we need. Precious metals are imperative, if you heard what I said about the Ibbotson study and the CPM study.
I got a friend of mine, he's a dentist, but he owns precious metals. And he heard Jim Rickards say that he predicts that gold will be in the 5 figures category. So Joe calls me up and he says, Bob, I have lost all respect for Jim Rickards. I said, what is it that upset you? He said, could you imagine he's claiming that gold could ever go to 5 figures? I have no respect. I said, Joe, what is Bitcoin now? Bitcoin is just about $60,000 for a Bitcoin. So if gold can go, or you say can go, to five figures, and how do you figure Bitcoin went to $60,000? And of course, you alluded to Bitcoin earlier, and you said you're no fan. I would call myself agnostic, and the reason I'm agnostic is that I'm a technological dummy. And I can't even use a cell phone. I'm not an engineer like you. I'm strictly an abstract thinker and a reader and a writer and a speaker, but I am the worst when it comes to anything technical. But I did invest in it, not enough to kill me. And of course, I think at the time it was about, I guess, 8,000 or 9,000. Did I ever expect it to go up so many times? In my opinion, it's completely nuts. But what is your thought on that?
Still formulating it. I mean, I wrote about it, I think it's 7 years ago now. It's called My 2 Bits About Bitcoin. You can read it. Basically, I wouldn't change a word. I said, look, if I am who I say I am, who am I to give you a price or a thought? The market knows more than me. That's my premise, is the free market makes a better decision than any one individual. If the market says it's good, then I have to say it's good. Personally, I'm not enamored with it that much, but let the market decide, not me. So that's the basic premise of the article. At the bottom of the article, I forgot because I just reread my own work because it's been, like I said, I think it's 6-7 years old, but regardless, it's a few years old. At the bottom, I said, by the way, I spoke with Richard Grove, who has the website tragedyandhope.org, I believe. And he did some pretty good research on it, because a lot of stuff that I write is, some of it's straight out of my head, my experience or whatever, but a lot of it is just, research. So I get, different people to help, or books or whatever. Anyway, he's pretty well studied. He talked about the possibility that Bitcoin was based on a white paper put out by the NSA. And I'd already gotten information on that from others besides Richard. So I put that in as a footnote to make people aware that, you got to look pretty deep on this stuff. You don't always take things at face value. Maybe it was an experiment put out by somebody at a rather high level to see what the adoption rate would be, see how the public perceived it over a decade. And then they had some motive in mind that maybe none of us are aware of right now. What I do want to add on to, Bob, is that I do think the blockchain's here to stay. I do think it's the basis of the next financial system. I don't believe Bitcoin is going to be the basis of the new financial system. I think it will be allowed to exist, but anything that's going to be done in the citizen marketplace, where the government of your choice, the one that you were born under, owns you, that you will have to use the central bank digital currency of your jurisdiction, and it may be one global one, but you will be a global citizen or perhaps a nation state citizen. If you want a mortgage, it has to be with the central bank's digital currency, centralized, not decentralized like Bitcoin. If you want to get a utility or a cell phone or an auto loan or a school loan, it has to be by a centralized digital currency. Will Bitcoin exist? Sure, I think it will. And if you want to buy a condo with Bitcoin peer-to-peer, fine. But if you've got to put a mortgage on that condo, forget about it. That's my take right now. I subject to change. I'm an open-minded guy. If I get more data and it says I'm wrong, I'll say I'm wrong, and here's why I'm wrong. Sorry, go ahead.
I was going to say that Bitcoin has more intrinsic value and efficacy than a mask, at least. So anyway, Dave, as we wind down, tell the listeners about the Morgan Report, all the value you give out, and be specific exactly what the report gives to the reader.
Okay, well, the best thing to do for anybody is go to themorganreport.com, that website, and get on the landing page. We'll have a free newsletter, which is all I need is a name and a primary email address, and then you'll get our free work. If you want our paid work, there's a tab that says subscribe. You press the tab, it doesn't make you a subscriber. It just gives you basically the sales letter. And there's a top thing about what I do, talks about the kind of analysis that we do, and that we do a lot of stuff besides gold and silver. We've covered rare earths, lithium, cobalt, uranium. Then I talk about having a model portfolio where we do the top tier, which is big money for solid gains, the mid tier for higher potential gains, but slightly more risk. And then the speculative section where you bet a little to win a lot. And sometimes we get 10 times or 40 times if possible. And sometimes they go to zero. And I specifically teach, when you become a paid member, how to use the Morgan Report. It's not a very long document, but it's imperative. It's a must read to understand how to use it properly. Big money goes at the top tier, medium money goes in the mid tier, and the speculations are just that: bet a little, win a lot. Look over my shoulder, you get to see every trade I make. I am a position trader, not a day trader, so don't expect to see 20 trades in a year. You might see 3 or 4, and I'll show you why I'm doing it, where I'm doing it, and how I'm doing it. It saves you time, it saves you money, and it saves you a lot of frustration. Updates and alerts. We've got the my cost, no increase in cost to the Morgan Report. We do put out text alerts now, which we never did before. Again, it wasn't real expensive, but it's not cheap. And every time I send one, it costs me money. We just work that into the cost of the newsletter, which is fine. You also get it by email. So you can have a text alert on your phone and also get it by email. You know what action to take. Critical information is received pretty much in real time. And we had a one-of-a-kind alert system, which we've kind of done away with because of the text function now. In-depth research, best of the best. Well, that's a bit of a comment, but I've seen so many other newsletters. I was a newsletter junkie during the first bull market, where I participated rather heavily between the early 70s and 1980, when gold peaked January 21st, 1980. As I said, I do have 40 years experience in the metals. And it's like having a gold mine of research and knowledge at your fingertips. We conduct extensive company analysis, make reports available to our members. We're the only newsletter who actively analyzes and updates our research report. I don't think that's true. I should probably take it off. But it is quite a bit for your money. Be the first to hear of new discoveries. Not every one of them. There's other newsletter writers that write up stuff that I don't want to touch. But the stuff that I really like, often we're the first, but not every time. So don't get, well, David, you said every time. No, I didn't. Some of the time I am the first. There's one right now that's an asymmetric trade. That's a precious metals recycling company using electronic waste. And we were the first on that. And very few other newsletter writers have even bothered to write it up. And lastly, as a paid member, you get to ask me one question a month. I guarantee you an answer. And finally, we have a lot of bonus reports in the members only section: the coming currency collapse, trading silver like a pro, taking silver delivery off the exchange, Buffett and silver, a gold clause written by the greatest constitutional lawyer out there, Dr. Edwin Vieira.
I had him on the show, and YouTube kicked it off.
Oh God.
Don't ask me why.
Yeah. Harvesting green on the pinks, how to buy penny stocks and not get burned. Pink sheets are penny stocks. For those that don't know it, I'm trying to explain it. You can look it up on Google if you want more information. But harvesting green means, money on the pinks. There's a lot of tricks to the trade that we'll teach you that'll keep you from getting burned on these little speculative stocks that we recommend from time to time. And 7 more reports to make you a better investor. So that is the long pitch on the paid Morgan Report. Thanks for letting me do that, Bob. No one's actually asked me to do that ever before, so thank you.
Well, you're kind enough to come on the show. The least I can do is let people know what you have to offer. Last question, last and final question. What percentage do you generally recommend between the physical metals and the stocks?
Yeah, I'm going to have to do this from memory, but it is outlined in how to use the Morgan Report. And again, it kind of goes back to the bond stock situation. The older you are, the more you would have in physical metal. And the younger you are, the more you can favor stocks. So I can't remember the percentages, but it's outlined and pretty well thought out. And all these are guidelines. They're not, well, David, you said, well, no. And then also in that, on the metals part, I go a little deeper and I say the older you are, the more you'd favor gold over silver. Well, David, you're a silver nut. Yes, but it's got more risk and more volatility. So as you are in retirement or approaching retirement, you actually want to, I think you should have both all the way up, but you'd actually favor gold over silver as you mature in age. So it's all outlined. I won't give you the numbers because I don't want to misquote it on your show, Bob. And thank you for having me. But it is outlined. And again, it's a guideline. Some people that are with me have no physical, which I really want to, doesn't make me happy because that's not what I teach. Everyone should start a metals portfolio with metals. I don't want you on the Morgan Report unless you own physical gold and silver. However, there is a few people that don't, but most people do. And I have a few people that are metals heads only. In other words, they really don't want the stocks at all. They believe in metal only, but they want my timing. They want to read about the details that we did on your program about, the ins and outs of the market, what I've seen the commitment of traders, my video updates I do, maybe what I'm doing in the bond market or the US dollar market, or maybe another market. So, there are people, I'm not suggesting if you're a metals head, buy the Morgan Report. That's all I'm saying. I'm just telling you that some people do. That's all.
Well, I appreciate your wisdom. And I think there's a reason why they refer to the senior years in human beings as the golden years,
Right.
because perhaps there's more wisdom in those years. And that wisdom has also to do with the fact that gold represents the wisdom of the ages. And thank you for representing that wisdom and for being the type of guy that you are. And can't give you enough kudos. And I appreciate it very much. And God bless you.
God bless us all. Thank you, Bob.
Take care, man.
I will.
Okay.